Hey, and welcome to how to analyze apartment buildings from A to Z in 30 minutes or less. I remember clearly when I first got started with apartment building investing, it took me 4 hours to analyze a deal. And number one is that way too much time because you have a lot of deals coming in. But number two, it delays the response that you have to the broker, which is bad. And after several of these, I was so overwhelmed that I never actually cracked open a deal. So I never had a chance to make any offers. And as you know, this is a numbers game, right? So the more you look at, the more you make offers, the more likely chance you have of getting a deal. So the key is to be quick about it. And the other mistake I was making is I was spending way too much time analyzing and researching and things of that nature when I found now that it's actually not really necessary. In fact, it's counterproductive. So there's a few tips you can do early on. I'm going to teach you how to do the initial analysis, which shouldn't take more than 10 minutes or less. When you first get a deal in, what do you do in those first 10 minutes to provide feedback and start a negotiating process? 10 minutes is all it needs to take. We're going to talk about how to structure the deal. If you have investors, particularly if you have investors, how to structure that deal, what that looks like, how to project the returns for the investors, how much to pay yourself, right? Because we're going to put a deal together, and how do we compensate ourselves for that? We're going to create a custom or P&L. How are we going to apply our business model, increasing rents, decreasing costs? How does that affect the overall model and the returns for yourself and for the investors? Then we'll look at the best way to exit the transaction. Is it a cash out refinance? Is it a sale in year 3, a sale in year 7? What's the most profitable? And then finally, we're going to put it all together. We're going to determine our final offer price with a deal structure, and we're going to create a deal package that we can give to your investors as well as your lenders as well. All right, so a deal comes in, looks something like this. Got some pretty pictures and some numbers. You don't want to spend too much time on this, so let's crack open the Syndicated Deal Analyzer. We're going to start with the Scenarios tab. You can see 4 columns here. And the first task you're going to try to do is you're trying to replicate the numbers in the marketing package. So that's going to be column 1. And you basically want to just make sure that the seller's or the broker's math is correct, and if not, you're going to use it against them to obviously get a lower price. So the first column, you go through and you're going to simply try to replicate the marketing package, all right, whatever's in there, and you're going to make sure the cap rate is the same, etc. Now, in the second column is going to be kind of your version of the truth, meaning that you may get a rent roll, for example, that doesn't match the numbers in the marketing package, and so your version of the truth, your income might be a little lower right here. Or you're going to use rules of thumb, meaning your expenses should be around 55% of income. If the expenses reported in a marketing package or the actual financials only 35%, you're going to correct that down here. When you do that, of course, the cap rate is going to change as well as your potential offer price because your net operating income is lower. Now back up here in the third column is the projected column. For example, if you're working on a value add deal, and let's say, as in this case, is the rents are below market. They're currently at $595, but the market easily, the middle of the market is at $750. So you want to create a column that's called projected. So your income is going to be a little higher here, for example, and your expenses are still going to be 50%. And what does that do to the cap rate and the net operating income and the value of the deal? How much should you take that into consideration? And then finally, column 4 is kind of your underwriting, what you're going to use for underwriting, for what we're going to feed the model. Right now, this is kind of a scratch pad, and in the offer, you may just decide to use only actuals. But let's say the building is empty. You can't use actuals because there's no income, so you have to use something for underwriting this deal. What will that be? So what kind of income are you going to use? Are you going to use the same as the actuals? Are you going to give it a little extra because there's considerable upside? What are you going to use for the expenses? So once you've decided that, in this particular case, we took the actual income, except for the reported expenses you see is only 36%, so we're using 50%. So we're going to use that, and we're going to feed the model. And by that, we're going to go to the Summary tab. And we're going to start entering the information in. This happens to be at 12 units. The asking price is $575. We're going to put a placeholder in there of $575. Now let's go through some of these other things here. So we have a down payment of 30%. We have an interest rate of 6% over 25 years. Now there's also room for a second mortgage. We're not going to have that right now. If you go down a little bit down, there's closing costs. We'll get back to that in a second. That's automatically calculated. We also have an acquisition fee that we're building in. And acquisition fee is something that you pay yourself for putting the deal together at closing. The default here is 3%. And you have a placeholder of about $25,000 in repairs as well. Your cap rate at resale is 8%. This happens to be an area where the cap rate is about 7.5%, so we're trying to be a little more conservative. And then in the next section, income expenses, we're going to use what we used in that fourth column under the scenarios tab. So we're going to add our gross income, the vacancy rate, and you see that 50% expenses. And that's what's going to feed the model for year one. Let's go down a little bit further. Down on the bottom, you will see some key indicators. You'll see the cap rate based on those net operating income and those financials, as well as the cash-on-cash return, the debt coverage ratio, and the gross rent multiplier. The next section is the investor section. Now, we're going to assume that you're going to have investors in this deal. Even if you don't have investors, this calculator will work fine. But if you have investors, this is where this is going to shine. So by default, we're giving the investors 70% equity with you retaining 30%. There's no preferred return to the members. There's an asset management fee paid to you as a manager, 1% per year while you own it. And there's a capital transaction fee paid to you as a manager when you sell it. That's 1% as well. And then below you see the returns, which is the average annual return of 8.9%, 8.84%, as well as the internal rate of return. And that is what drives the entire deal, is the return for your investors. Now, speaking to the investors, with the analyzer, you can quickly see what impact it has when you change different variables. For example, in the investors, let's say you want to increase their returns. You might give them 80%. That increases their average annual return to 10.10%. Obviously, if you give them more equity, the return is going to keep jumping up. So you can see the impact of that. Put it back to 70%. Let's say you want to pay them out a preferred rate of return, and you want to pay them 5% preferred return, but you only give them 50% equity. What will that do to your average annual return? What will happen if I scroll up to the return if I decide to pay myself a 1% acquisition fee? The return obviously goes up. So you can play with different things to achieve the return for your investors that you desire, and that is the overarching priority when you're putting together a deal, is the return for your investors. So the analyzer allows you to do that very quickly, playing with different levers to see what the impact will be. So you can quickly see how you want to structure the deal with the investors, what kind of equity, what kind of preferred payout, what you're going to pay yourself, when and how much, and how that affects the model. Now again, speaking of returns, this will give you kind of the snapshot of the overall return over the life of the investment. But if you want to get a breakdown of that, you go to the returns tab. Here we are in the returns tab, and there's several sections in here. The very top section is summary of projected member cash flows and returns, and that is an overview of what your investors will earn. It will take a combination of cash flows while you're holding the asset and the cash-on-cash return, what the member capital invested is, and that's how you calculate the cash-on-cash return, plus what kind of profits they will get upon exit. That's the last column there. Below that is a summary of projected manager cash flows, and that's the cash flow that you will expect, and that's going to be a combination of acquisition fee, of the equity distributions you're getting, and any asset management fees, as well as capital transaction fees when you sell, or any net proceeds from refinance or sale, which is the last column. And finally, the last one down below gives you a combination of those. So if you want to see what the raw returns are without investors and without you being paid, that's what you get in that last section. Now let's look at the acquisition costs tab here. This estimates the acquisition and closing costs for a deal. And there's several placeholders in there, and you can update these. For example, if you're not going to do a private placement memorandum and you're only doing an LLC, this might not be $11,500. This might only be $1,500. If you don't need to do a lead paint inspection in your jurisdiction, you would hit this to 0. You want to get with your closing company and see what your transfer fees are, etc., and you're going to update these rules of thumb a little bit. But this will give you an overview and some rules of thumb of what to include for closing costs, and that is then displayed in the summary here under closing costs. So that's the acquisition and due diligence cost tab. Now, as we talked about, if you have a value add deal, you are going to try to increase income and decrease expenses over time. And the way you do that in this model is you click on the P&L tab. This gives you the 10-year profit and loss projections. And by default, your rent goes up by 3% and your expenses go up by 3%. And it takes your first year that you put in your summary tab and simply calculates that through year 10. But as you can see here, what we've done here is we've overridden the rent. So in year 1, for example, the average rent is $595, and we're going to say that it takes us 3 years to get up to that target of $750. So each year the rent is going up a little bit. I'm going to override this model here. Sometimes you may want to do the same thing with expenses. Maybe when you get into a deal, the expenses are 75%, and you're going to whittle that down to 50% over the course of 3 years. So you can override this P&L as well until you stabilize this thing. You can even itemize this down to the exact level. Let's say you're working on real estate taxes and it was bought for a very low price 3 years ago, but you're buying at a much higher price. Well, what is that going to do to the expenses? So you can actually go through line by line and create a business plan for each one of these line items. So you can be kind of broad brushstrokes or you can be very detailed. And that's how you create a custom business plan. And every time you do that, when you go back to the summary tab, it will show you the impact that change has on your returns that you see at the very bottom there, as well as, of course, the returns tab. Now, for example, this one here, I have an average annual return of 10.46, and that may not be enough, so I may not offer or pay what is being offered. I may do something, offer something less, and then I can see what impact that has on my returns. Now we're just under 14%. If that fits your criteria, then you know that's your maximum price that you can pay, for example. Now there's one very exciting section, which is the exit strategies tab. Let's look at that. This one, by default, the Syndicated Deal Analyzer assumes that you're going to sell the asset after 5 years. But what I wanted to do, and others as well, is we wanted to model different scenarios. We want to model something where maybe we're selling it in year 4 after we've created all the value and stabilized the building. Or maybe want to hold it till year 9. Or more exciting even is, what if I can do a cash out refinance after I've stabilized a property, return all or part of the principal back to the investors, and then hold it for another, 7 years. What would that look like? So let's look at the summary tab here. Right now we're looking at the internal rate of return of 12% for the investors. Now what would happen? This is a value add deal as we've talked about. What would happen? So it's 12%. What would happen if I refinance this year's in the beginning of year 4, which is after I've created lots of value, and then I'm going to hold this thing and sell it in year 8? What happens to my internal rate of return? So that's what I've done here. And when I do this first section models what the refinance looks like, what the value is, the cap rate, the proceeds, what happens to the cash that's left in the deal by the investors. As you can see here, that there's only about $5,000, $6,000 left of the investor capital. So almost all of it was returned to the investors. And then this section here models the ultimate sale. Again, the cap rate, the closing cost, the proceeds, what the loan balance is, all that stuff. And it combines all that stuff, and you look in the summary, and now you see that the internal rate of return jumped from 12% to 14%. So the combination of a cash out refinance, hold and sell can often boost the returns. But how do you know what year and when to do that? And this helps you do that. There's other couple of tabs here, which calculates the internal rate of return. So that's where that comes from if you really want to know where that model comes from. And then here are the loans. So these are loans of the first and second mortgage and the refinance one. So it gets a little complicated back here, but normally you're never in these tabs. But some people want to override or even understand how this works. So it has the amortization table for the first mortgage, second mortgage, first mortgage that's been refinanced, etc. So those are the tabs you probably don't spend a lot of time in. And you can take the information in the Syndicated Deal Analyzer and very quickly copy and paste it into your deal package that you can give to your investors and other professionals. So here we are in our deal package, and you can use the outline that I have in here. We have just a photo up here. We have some boilerplate. We talk about the executive summary. Hey, here's what we're talking about. Minimum investment of $100,000. Here's what we're going to do. We're going to add value, etc. We're going to talk about the property. And we're talking about the business plan that we're going to add value, and we're going to refinance in year 3, et cetera, et cetera. And we're going to talk about acquisition summary, and this is where we copy this information straight from the Syndicated Deal Analyzer. In fact, a lot of these sections will come from there. So we got the rent roll, we got from the marketing package, and the financial projections come right from the P&L tab. We just copy and paste that, and we put it right in here. We talk about our resale assumptions, the returns, and that comes straight out from the marketing package right into your deal package. So the Syndicated Deal Analyzer not only helps you analyze deals, but it's very easy to create a deal package simply by copying and pasting the things that are already there. You don't need to reinvent the wheel, just copy and paste that into your document, put some text around it, and you're good to go. We covered a lot of ground here in this training. We talked about how to analyze a deal in 10 minutes or less. We talked about how different ways to structure the investment with our investors, how to pay ourselves, how to create a custom P&L with your business plan. We modeled some different exit strategies, and we created a deal package as well. The Syndicated Deal Analyzer helps you address all these things in only a few minutes, and it saves you a ton of time. But there is a learning curve, I realize that, and you spend some time together here, but if you decide to purchase the Syndicated Deal Analyzer, it will come with 90 minutes of video that goes into detail about each one of these things that we kind of talked about today. When you log in to the Syndicated Deal Analyzer, you will see a list of all the videos, starting with what you do when a deal first comes in, and the 10-minute analysis, understanding investor returns, how to pay yourself, sharpening your pencil, fine-tuning the P&L, estimating due diligence costs, modeling different exit strategies, reviewing the deal, and creating the investor deal package. Everything that we've covered, but in much more detail, about 90 minutes worth. Now, the Syndicated Deal Analyzer is a bit different and unique from other things you might have seen. Number one, it's fully editable. A lot of software out there is either software or password protected, and I made it fully editable because, number one, you need to be able to customize it with whatever you want, and number two, it allows you to better learn if you can see the formulas and how things work behind the scenes. Number two, it's structured so that you can quickly analyze deals and answer the question, what is the most I can pay and why? But nevertheless, it allows you to go deep as you go into due diligence. Number three, it has a particular focus on raising money and syndication, allowing you to quickly calculate investor returns and see what you're getting paid as well. Allows you to model value-add deals and customize the P&L. And, very unique, you can model exit scenarios, simple sale, cash out, refinance. And you can use it to quickly create a deal package. Now I'm going to give you two reasons that you need to purchase the Syndicated Deal Analyzer. Number one, you need this. And if not this, then something like it. Because if you want to get started with investing in apartment buildings, you need to be able to analyze a deal and be able to make offers. Absolutely. So if you don't purchase the analyzer, then you need something like it. So consider your alternatives. Number one is build your own. I mean, certainly I did that. It'll take you hours and hours and hours and hours and possibly years to kind of get it right. Not really worth it, frankly, especially if the wheel's already invented. Now, the second one is buy another one, and that's fine. There are some other ones out there. That's perfectly fine. Purchase the tool to get the job done. And number three, of course, is do nothing. But as we just talked about, you need to be able to analyze deals and make offers. So you need something like it. Now, remember, you're going to get a 60-day money-back guarantee. So if you purchase the Syndicated Deal Analyzer, your size not for you, just send me an email, and I won't hassle you for a refund. I'll also give you a few updates. And since I put it out about a little bit over almost 2 years, I've had at least 3 updates. Some of them are major, and I'm not charging you for those. So you'll get free updates as well. Here's what some others are saying, and these are, by the way, from the biggerpockets.com, and these are non-solicited feedbacks, people asking out there, hey, what do you guys have for analyzers out there? And people just say, hey, this is a great product. This is what Karma says. I truly have to give a plug here for Michael Blanc's Syndicated Deal Analyzer. I don't even know if this plug will even be allowed, but I have to try. That's funny. I've been using this tool for about a week now. Let me tell you, I love it. He says he gets absolutely no compensation for this anyway. Just love the tool. I appreciate it, Karma. Here's a few other ones. Joe Fairless, the host of the very popular podcast, Best Real Estate Advice Ever, he's also a customer, and he also unsolicited posted on Bigger Pockets in response to a question. Here's Russell, Brazil. I use what Michael Blanc created. You have to purchase it, but it is much more in depth than your typical Excel sheet. He does say it's a little complicated to use at first, but once you get used to it, you really do you see the power it has. It allows you to customize a lot of things besides just looking at the operations of the apartment building. It allows you to customize how the deal to purchase the apartment building is put together, what percentage of equity you get if you have partners, etc. Let's listen to what Jay Boyle has to say. He used a syndicated deal analyzer to analyze hundreds of deals and just recently bought a 32-unit apartment building.
As soon as I started realizing that I wanted to be in larger multifamily, I started looking around at different sites. I found your website and I listened to a lot of the podcasts on there, and some of those podcasts were really inspiring to me, very inspiring. When I found the Deal Analyzer, the software, that really helped me a lot. I had a program, a spreadsheet for smaller single families and up to fourplexes that I really enjoyed. I used that a lot, but that was not at all useful for the larger multifamilies. And also, one of the great advantages of multifamily is the idea of syndicating the deals, because it's a format, it's a way to use other people's money to leverage your own funds, to create equity, to get into larger deals sooner. And in order to analyze larger deals, you have to have a great tool in order to analyze them. And the other tools that I looked at were not good. But your syndication analyzer was fantastic. I use it every day. And I can analyze properties in just a few minutes. I can plug in the parameters and I can see what kind of returns I'm going to be looking at, what are the possibilities for the investors and for the management. So you have to have a tool that's like that. If you don't have that tool, you need a different one, but the Deal Analyzer is very, very useful for me.
Cool. So I want to shower you with 3 bonuses. Number 1 is the Word template of the deal package. And the deal package is something that we use to take the financials from the analyzer and create a investor package that we can use to raise money. So I'm going to give you the Word template of that, and you just copy and paste stuff from the analyzer into this Word template, and you have a tool that you can use to raise money. Number 2, I'm going to give you 2 full-length video case studies, and these are all going to be between 45 and 60 minutes. This is something that I do only for my coaching students, but I'm including it here because I want you to see the analysis, not just for the case study we're doing for the 90-minute training course that you get with the analyzer, but I want you to see it for 2 additional deals. Okay, you can get the full-length video analysis for that, the completed analyzer for it, as well as the marketing package. Okay, so it's almost like you're watching me analyze these 2 deals for you. And I'm going to give you a 39-page ebook as well. So the entire course is basically in a PDF as well. So if you want to read it while on the road, this is the way to do it. And I'm including that here. And I will probably sell this separately in the future. So here's what you get. You get the Syndicated Deal Analyzer, easily worth $200 just by itself, for cutting down on the time it takes to analyze deals. Then the 90 minutes of training videos, 60-day money-back guarantee, free upgrades. You get the Word template of the deal package, $50 value. You get the 2 full-length case studies, $75 value, and you get the 39-page ebook, the whole thing, $100 value. Add everything up, is $575 in value, and everything here will kind of make you the apartment building deal analysis master. Everything you need is in this package. You absolutely need this to get started with apartment building investing. And I'm not going to charge you for that. I'm asking $129 for both the spreadsheet software as well as the training videos and the bonuses. And as always, you have the 60-day money back guarantee. So if you purchase this thing and it's not what you want or are looking for, just contact me. I won't hassle you for a return. But I am convinced that you will love this tool. So many hundreds of people have already downloaded and have told me this is the best tool they've seen on the market. And I hope you agree. So go ahead and take action now. Click the Purchase Now button, and I look forward to working with you. Hey, and thanks for sticking with me for this long. That really sets you apart from 90% of other people out there who have decided not to take action, but you have, and that's fantastic. So if you want to cut down the time it takes to analyze deals from hours to minutes, you save a lot of time, consider purchasing the Syndicated Deal Analyzer. To do that, just click the purchase button below. It'll open up a shopping cart and allows you to securely check out with credit or debit card. Remember, there's a money-back guarantee here, so if you download this thing and you say it's not for me, you just send me an email and I won't hassle you for a refund. You will love the Syndicated Deal Analyzer, and it will be an indispensable tool in your real estate investing career. Thanks again, and I'll talk to you later.